Hello, everyone. Welcome back to Gold Off the Charts. In this unpredictable financial game, we don't just look at the hype, we look at what's really happening behind the scenes. We're here to sharpen your financial edge so you can stay ahead of the curve and build wealth with confidence. Over the last 2 days, the precious metals market has been nothing short of insane. Gold is defying gravity, holding strong above the $4,600 mark, and silver is like a waking lion, surging nearly 5% in a single day, hitting record highs 2 days in a row, and even touching the $90 level. With the market pumping like this, I'm sure those of you watching have two voices fighting in your head. One says, hurry up and buy or you'll miss out. The other says, it's gone up too much. Is it about to crash? Everyone, take a breath, because just yesterday, in this up-and-up market, two huge new variables suddenly appeared. These variables are like finding a kitchen where the oil is already boiling and pouring a bucket of high-grade gasoline on it while simultaneously planting a fuse that could blow at any moment. First, we have a civil war at the heart of U.S. power. Trump actually used the Department of Justice to launch a criminal investigation into Fed Chair Jerome Powell. This isn't a movie, it's a financial coup in real time, and the U.S. dollar's reputation is being sabotaged by its own president. Second, there's fear among the market makers. The CME Group suddenly changed the rules for margin, moving from fixed to floating. What does that mean? It means they are scared. They are changing the rules to limit your leverage because even the exchanges can't handle this much volatility. How will these new factors change the game for what's coming next? Facing this massive, tempting, but dangerous market, should we regular investors get greedy and buy more, or take our profits and run? In today's video, we aren't going to bore you with useless technical indicators. We're going to look past the headlines and break down the logic of these new variables. I'll give you a practical guide to surviving and profiting in these chaotic times. Let's look at this historic market. With things so complicated, should we run for the exits, or should we get greedy? If the market action lately has you feeling anxious, you'll have your answer by the end of this video. First, let's review the data that shook the world last night. The U.S. Consumer Price Index for December, better known as CPI. When the numbers dropped last night, the market's first reaction was actually a bit confused. The data showed CPI rose 0.3% for the month and 2.7% for the year. The more important core CPI was only up 0.2% for the month and 2.6% for the year. What does this tell us? It means inflation was slightly lower than the 0.3% and 2.7% Wall Street expected. This is what we call a moderate inflation environment. If we go by the textbook, lower inflation means prices are under control, which gives the Federal Reserve a great reason to cut interest rates. And that's exactly how the market reacted at first. Bets on rate cuts this year jumped instantly, with most people expecting 2 cuts in 2026. According to the CME FedWatch tool, even though a March cut is less likely now, sitting at only 27.4%, the market has already priced in about a 0.5% total cut for the year. Usually, low interest rates are great for non-yielding assets, like gold, meaning assets that don't pay you interest, because the opportunity cost of holding gold goes down. It also weakens the dollar, making gold more attractive. But, my friends, the devil is in the details. This data, which looked great for gold on paper, actually caused a very messy reaction in the market last night. As you saw, gold didn't just rocket to the moon as people expected. It spiked, then quickly gave back those gains. This shows the market isn't just blindly optimistic about this inflation data. Overall, while the December numbers showed that inflation is staying stable, the fact that core inflation was lower than expected confirms the idea that inflation is definitely on its way down. This has calmed one of the market's biggest fears. The fear that if the Fed cuts rates too early, we'll see a 1970s-style inflation nightmare. For now, that risk seems to be off the table. But there's a flip side. While low inflation helps the case for rate cuts, it also hints at a deeper issue: the U.S. economy might be cooling off too fast. Does low inflation mean demand is dying? Is a recession coming? Investors are now weighing whether the Fed will actually become more cautious because of this. This was highlighted by Street Lewis Fed President Muslim, who said that since inflation is still above the 2% target, there's no real reason to rush into more rate cuts soon. His words immediately poured cold water on the market's hope for a quick cut. Meanwhile, let's look at the bond market. Although Treasury yields dropped, The move was tiny. The 10-year yield fell to 4.175% and the 30-year to 4.823%. This wait-and-see mood in bonds didn't provide the strong boost gold needed. My conclusion? While moderate inflation keeps the rate cut dream alive, it also reveals a short-term problem for gold. People are ready to take profits. Last night's up and down move was just the buyers running out of steam after a long rally. It's a case of the market selling the news after a good run. Next, let's talk about a question on everyone's mind. How will the recent dollar bounce affect gold? Because expectations for an immediate rate cut have cooled, the US dollar has actually firmed up over the last 2 days. History shows that when the dollar goes up, gold usually feels the pressure. Since gold is priced in dollars, a more expensive dollar makes gold look pricey, so fewer people buy it. Especially when inflation is moderate and the economy is steady, this seesaw relationship becomes very obvious. The dollar bouncing and gold retreating after the CPI report is a perfect example of this logic. But I want to be very clear. Do not be fooled by this short-term bounce in the dollar. The crisis the US dollar is facing right now is unlike anything we've seen. It is structural and potentially devastating. A quick rally can't hide the fact that the dollar's foundation is shaking. Why do I say that? First, there is massive political chaos inside the US. The Trump administration investigating the Fed's independence is unheard of. We'll get into that more in a bit. This is like a nuclear bomb hitting the dollar's credibility. Second, the trade war is escalating. Trump threatened 25% tariffs on Iran's trading partners. This isn't just about Iran. It's a declaration of war on global trade. It has people everywhere worried about the US abusing its power, and they are thinking, if I use dollars, will I be the next target for sanctions? This fear is speeding up the global move to dump the dollar. Then there's the geopolitical madness. The US moves regarding Greenland have strained relations with Europe. The EU and Nordic countries are actually warning that this could be the end of NATO. When America's oldest allies start questioning its leadership, the dollar's status as the world's reserve currency starts to crumble. All of this is making people hunt for safety, further destroying trust in the US dollar. On top of that, we can't ignore what's happening in Asia, specifically Japan. Prime Minister Takaichi's easy money policies could cause the yen to crash even further. While a weak yen pushes the dollar index up on paper, it adds massive uncertainty to the global financial system. Japanese officials have already threatened to step in, which is like a ticking time bomb for market volatility. So, in this environment, even if gold looks like it might have peaked in the short term, it's way too early to call the end of the bull market. Inflation is still too high, and most central banks are still cutting rates. Add in the intense rivalry between world powers, and gold's status as the ultimate safe haven isn't just solid, it's irreplaceable. Now, for the most important part of today's video, the main driver for gold's long-term growth, the Federal Reserve crisis. After the DOJ investigation caused a stir, Trump's personal attacks on Jerome Powell have added more fuel to the fire. On Tuesday, as Trump left the White House for a speech in Detroit, he spoke directly to reporters. He said Powell wasted billions of dollars, which is either incompetence or corruption. I don't know which, but he's doing a bad job. Think about that. Is that how a president talks to the head of the central bank? Calling him incompetent and corrupt is like dragging the Fed's reputation through the mud. After the CPI data came out last night, Trump spoke again. He said inflation is low, which gives slow-moving Powell the chance to give us a big, beautiful rate cut. Then he dropped a bombshell, saying he would name a new Fed chair in the next few weeks. He made it clear the investigation into Powell wouldn't change his timeline. In his Michigan speech, he flat out said, "We have a bad Fed chairman." At the Detroit Economic Club, he kept going, calling Powell very rigid. He argued that even if the economy is good, the Fed should still cut rates. His logic is, if the data's good, the market should go up, not down. And he wants rates to drop while the market is already doing well. Everyone, this is blatant interference in monetary policy. Trump's comments on Tuesday were a massive escalation. For the last year, Trump has constantly criticized Powell and demanded fast, deep rate cuts. He even suggested that unless a Fed chair candidate promises to cut rates, he won't nominate them. This sets a political standard that destroys the Fed's independence. A Fed spokesperson refused to comment. But Powell fought back in a statement last Sunday. He called the investigation into their renovation projects an excuse to pressure policymakers who won't give Trump the rate cuts he wants. Powell said something quite powerful. It's about whether the Fed can set rates based on facts and the economy, or if policy will be ruled by political pressure and bullying. What's even more shocking is that after this pressure from Trump, the world's major central banks issued a joint statement to support Powell. On January 13th, central bank governors stated, "Central bank independence is the foundation of price and economic stability for the citizens we serve. It is vital to protect this independence while respecting the law and democratic accountability. This rare joint reaction shows how worried the world is. The independence of the world's most important central bank is under direct attack. Usually, this kind of coordinated support only happens during global crises like 2008. Using it now to protect one person's authority shows how serious things have become." ECB President Lagarde, Canada's Tiff Macklem, and Germany's Joachim Nagel all stepped up to support Powell. It's like all the world's financial leaders are banding together to maintain some kind of order. Even retail investors are backing Powell. On the Reddit forum, Wall Street Bets posts supporting Powell went viral. Retail traders are calling him an American hero and the GOAT. What does this whole circus tell us? It tells us that no matter who the next Fed chair is, the damage is done. The Fed's independence is now being questioned. If investors start believing Fed decisions are made to please the president rather than help the economy, the dollar's credibility will collapse. That's why everyone is buying gold like crazy. Gold doesn't care who the president is. Gold is the only truly independent currency. Moving on from politics, let's look at two big changes at the micro level of the market that affect your wallet directly. The first is that the CME Group has changed its rules. According to a notice from January 12th, the way margin is set for gold, silver, platinum, and palladium is changing. Before, it was a fixed dollar amount per lot of gold. Now, it's calculated as a percentage of the total contract value. Margin for some gold contracts will be about 5% of the value and about 9% for silver. Why does this matter? It changes the rules of the game. Before, when prices went up, your margin stayed the same, so your leverage actually increased. But now, your margin moves with the price. When prices are high or volatile, you might get more margin calls, and your capital isn't as stable. This puts huge pressure on traders using high leverage. In the short term, this could lead to less liquidity, forcing traders to close positions and making prices swing even wilder. This is one reason why we've seen such sharp intraday swings lately. However, look at it from another perspective. Why did the CME do this? Because they're scared. They see how fast these metals are moving, and they had to raise the bar to protect the exchange. What does that tell you? It shows that the demand for gold and silver is so high, it's scaring the people in charge. This actually makes these metals more exclusive and is good for the long-term price. The second change is about silver. The CME Group announced they are launching 100-ounce silver futures to meet record demand from retail investors. If approved, it launches on February 9th, 2026. The head of CME's metals division was very honest about it. With geopolitical stress and the energy transition, silver is becoming a favorite for retail traders looking to spread their risk. This is huge. It shows big institutions recognize that regular people want silver. 100-ounce contracts are cheaper and easier to trade. This brings new blood into the market. Silver's popularity is growing, providing a solid foundation for prices to keep rising. Finally, let's talk about what you really care about. In this wild market, what should you do? First, let's be clear. Why gold is going up has fundamentally changed. It's no longer just an inflation hedge, it's now a hedge against government credit. When the people running the world's most powerful economy, the Fed, face political bullying and criminal probes, and when the dollar is used as a political weapon, traders naturally run to non-government assets. What is a non-government asset? The oldest and most trusted is gold. So for you investors, my advice is simple. First, stay confident. If you bought in at lower prices, don't get scared out by a $50 or $100 swing. This is a long-term bull market and a historic opportunity. don't lose sight of the big picture just because of a small distraction. Second, don't overtrade. With higher volatility and new margin rules, trading too much can get you shaken out. You could even be liquidated if your margin isn't high enough. In a bull market, the best way to make money is often to just sit still and wait for the long-term gains. Third, keep a cool head. Even if I believe gold is going to $5,000 or higher, it won't go there in a straight line. There will be dips, shakeouts, and up and down days like last night. Treat these short-term moves as the market breathing, and don't panic just because of one bad day. In short, in these chaotic times, gold is your financial life raft. Whether it's Trump's comments, the Fed struggle, or global wars, all roads lead to gold. Finally, a quick reminder. Everything I've analyzed today is based on my own research and logic to help you see through the noise. This is not direct financial advice. Trading is risky, and you must be careful. Everyone's budget and risk level are different, so you should follow your own style and make your own decisions. Investing is a journey. Use other people's views as a guide, but trust your own judgment. That's all for today. If you found this helpful, or if it helped calm your nerves about the market lately, please leave a comment and let me know. Don't forget to like, subscribe to Gold Off the Charts, and share this with your friends. I'll see you in the next video.